Yeah, just to get started here, like, so you had a big week with Varsity Gems we talked about last time, right?
Yeah. Yeah, I mean, it's been great for us. We brought on some interns, and they've been killing it this summer. They're both college athletes themselves. Grace, who plays softball at Calvin University, and Jonah, who plays football at Kalamazoo College, which is also my alma mater, Go Hornets. And they are connected to a bunch of other student athletes and have made it easier to reach out to student athletes because getting a reach out from me probably isn't as exciting as hearing from one of them. So they've just started killing it as far as getting into the face of student athletes and also getting the athletes to respond, send us images, want to sign the contract and get excited. We spent this morning with some Grand Valley State football players who want to do a pretty big spread with a number of teammates. And so we hope to be able to get a big chunk of their team and also another team, Hope College, here in West Michigan, that are really close. They're, Grand Valley's in Allendale, Hope's in Holland, so they're about 20 miles apart. And we've got a lot working there. What's cool is now as we look at our metrics and we start saying, what do we need to do between now and the end of the year to hit our goals? We're right where we need to be. And we're starting to get to that point where we can see the buildup happening. And the more athletes we get on, the more inventory we have, the more we can get people to show up and buy the NFTs themselves. And from a tech standpoint, we're ready for launch. So we're going through some final security testing, and then we can go live and put the site out there with our NFTs for sale. And so we've got 3 really cool populations: baseball players, hockey players, and now we're starting to get a ton of college football players, and a 4th population, college basketball players, who, as we get closer to basketball season, will allow us to do a pretty big launch. So we're pretty excited about it. A lot of anticipation. The reality is when we meet with student athletes, they're saying they don't get a lot of opportunities under NIL. A, and B, that they're getting a lot of things that they don't want to do, but this is something they would do because it's relatively simple, doesn't cost them anything, and it's something that they don't have to go shill for a brand or do something like that. It's something they can actually say, it's me, it's my real name, image, and likeness, and feel personally good about it. And the other thing is athletes are getting the message that they can connect with their fans this way. And that's the other cool thing about college sports, is the ability to connect with your fans and to connect with the little kid who might be at a Grand Valley game. It doesn't seem like a big deal to us because it's D2 football, but to a small kid, it might be the biggest thing in the world. They're at a stadium and a kid, hey, I know that kid, and I've got his picture, his NFT. So
Yeah, it's good. Like we talked about last time, I love trading cards. I used to collect them as a kid all the time. So there's 2 things. So number one, if anyone's out there is interested in being involved with Varsity Gems, it's obviously one of our Omega companies. If you want to invest your time, money, or anything, just reach out to me and I can give you more information about that. But I wanted to take a step back because you talked about interns. And a lot of times people say, just hire an intern, just hire an intern.
yep.
And personally, I used to do it, but I had someone manage them because it was not easy just to quote unquote hire an intern to do it. So can you kind of talk about like that process?
Well, I mean, for me, it was interesting. So I knew Jonah. He's a little bit younger than my oldest son, so they had played sports against each other. He played at the same high school I went to and now at the same college, and his high school coach was my college coach. So I kind of knew the mindset he would have and where he was coming from, because when even though it's been 20 years apart, the coaching mindset that my coach brought to the table, I knew who I was getting, right? So he was easy. The second person, Grace, she actually applied. I was working with a Calvin professor and having some conversations, and he said, I'll help you get the job posted. And a bunch of students applied. She was the first one to do an interview with us. And the fact that, 1, she was a student athlete, and 2, that she was just impressive in her interview. She showed up. And what's been great, to your point, yeah, sometimes you hire interns and you don't know what you're going to get. Are they going to be self-starters? Are they going to be people that want to come in and work? How do you manage them? How do you get that process going? From day one, they're like, give us more. Like, well, you're not giving us enough, so we're going to go do our own thing. And they have taken the initiative, which is, in the startup world, what you want to see, right? Like, although they're interns in title, they're members of the team, they're peers at this point. And the great thing for me is I'm in a business that's younger than I am, meaning it's a business that technically guys my age shouldn't be involved in. They bring that mindset of that age group and can say, this is how we should phrase this, or this is how we should approach this, and give me advice on things where I would probably have missed the mark. And I think that's been really helpful. So they've been a godsend. And I would say the fact that this generation of kids, you've got a lot of them that are very good in this digital space that we had to learn. At my age, had to learn. They've grown up in it, so they have some advantages. The disadvantage of interns, obviously, is they're young. There's no gray hair. There's no experiences. They haven't been jaded. But what's cool about these two is they came from good backgrounds. They're blue collar kids. They're hard workers. And this, because they're athletes, we know they're the kind of people that set goals and want to train. So every time I've hired interns, I've had pretty good experiences, probably except for one. And the one experience where it was bad was probably less a factor of the intern and more a factor of who was supervising them. And could that person that was supervising them, this case, me, give them what they needed and feed them what they needed. In this case, I don't have to feed. They can feed me a little bit, which is great. So.
Yeah, I love that. So last time we talked a little bit about convertible debt, and that's the instrument you use in a convertible note to raise money for Varsity Gems. Can you talk a little bit about that? Because obviously there's lots of ways to raise money these days. And like, I think you said this last time too, in the Midwest, convertible notes are like the big thing. And I would agree with that. I mean, I raised money on the convertible note and straight equity and crowdfunding and all that. So I'm just curious to know, like, why, number one, it's typically your method of choice, and then we can walk through like some scenarios with that.
Yeah, I mean, to me, it's just a standard tried and true method that has been out there for a while. It's well accepted by investors. And in our case, what's great about a convertible note is it's an investment, but it's treated as a loan initially. So the documentation looks kind of like a loan documentation, but it converts at certain points down the road if your company succeeds. The great thing about it is it's friendly to both an entrepreneur and an investor, because if the company is a home run and it succeeds and it becomes this big 10x plus return, they can have equity of this rocket ship to the moon. And you, as the person that is raising money, has somebody that's an equity holder, but you're not giving up that much. They're buying in at a discount based on the money they gave you up front. So you're not giving away some huge chunk of your company right away as you grow, assuming your valuation goes up. If it's not a home run and it's just a good double or triple, they still benefit because they're getting paid back. They may still want to convert to equity at some point in time. The goal there being that you either want to get to where you're taking on further investment, or your valuation's gone up and someone's acquiring you, something along those lines. But even if it's just a single and you just go out and deliver and you run a standard business, they can get paid back as if it's a loan and get some interest rate. So it's got an equity discount at the back end, but it's also got an interest rate on top of it. So it's a little bit of a hedge against saying, hey, this doesn't have to be a home run. And if it fails, which a lot of businesses do, it's relatively easy to sort of get out and they can treat it as a loss. You, as the business, essentially would have to file your bankruptcy at that point, or do whatever you're going to do to unwind the company and move on. So it's very friendly for early stage investment. It just is. The language is really simple to understand. It's not a complex instrument. There can be complexity to it, but for the most part, you can say, here's what it is. It's a loan for 18 months at this interest rate. And either I start paying you back at that point in time, we fold up shop, or we're doing so well, hopefully, that you're getting a chunk of equity in this new exciting company at a discount. Beneficial for everybody involved. And it makes life easier at the time that conversions are happening, because instead of having to worry about what the next investor is thinking, it's really simple to take care of those initial investors that came in. And that's the big thing, is when you're taking on investment, oftentimes people are so obsessed with the money they're taking in today. You have to think about, what am I going to do in my next round and the round after that? And a convertible note positions you well for those rounds in the future. And that's something to take into consideration. Not that crowdfunding doesn't, or some of the other methods don't, but like if you give up 25% of the equity in your company and just take in investment on straight equity, now another investor might say, hey, that's a red flag for us. We don't want to invest in you because we're diluting you and you're going to not want to be as motivated, So it's just a great way to keep that around. And of course, with crowdfunding, the thing you run into is if you don't structure it right, an investor may say that's too complicated to unwind. We're not going to give you money next round because you've got all these shareholders or all these investors out there and your cap table's a mess. Structured right, that's not a problem. But unfortunately, in a lot of crowdfunding raises, people don't do that. So, yeah.
Yeah, so let's talk about a couple of scenarios in my mind, because I mean, like I said, raised my hand before. What about the businesses that are kind of just limping along? That they're not rock stars, but they're not like, they can't really service the debt either. After 18 months, they're still kind of finding a way. They might have pivoted once or twice, still trying to figure out, find that product market fit.
Yeah, I mean, it's all of those scenarios are like, relatively likely to happen, right? They're not unthinkable. And I think what I would always stay in mind is if you're not able to service the debt, this is a negotiable instrument, right? So you can go back to those people if you have a good relationship and say, hey, here's where we are. And we've all, as entrepreneurs, been in that position where we've had to go back to the investors and say, hey, this succeeded and we're getting acquired and this is great. That's the fun conversation to have. But a lot of us have also had to go back and say, I've only thankfully once had to go back and say I failed miserably. That in between conversation is always fun, where you say, hey, we're doing okay, but we're not doing great. And because we're not doing great, this is the position we're at. And we'd love to be able to start paying you back right now, but it may not happen. Would you be willing, one, to negotiate different terms, or two, do you want to convert? What do you want to do? And it gives that investor some options that are usually defined by the note, but it also gives you as the entrepreneur some wiggle room where it doesn't kill your company. And that's the other thing, is if you get to a point where you're limping along, is probably, that's one way of thinking about it. But the other thing is, like you said, maybe you're still trying to find that product market fit, and maybe you've pivoted a little bit. So maybe you started off down the wrong path. Now you've adjusted, and you just need a little bit more time to get to where you need to go. They still are going to want to be involved with your company. And as long as you're communicating with them and being upfront, it gives them that opportunity to be involved in a conversation without taking a major hit, and it's not a total defeat at that point in time. The difficulty as an entrepreneur, though, is sometimes, you just reach a point where you're not, the term we hear a lot is scalability. And sometimes you start a startup thinking it's a very scalable idea, and it just simply isn't. And for whatever reason, you're not going to be able to hit that scalable point. And that's okay. There's plenty of businesses that don't scale very well. I was actually just making a joke with a friend because he was offering free snow shoveling in Fort Lauderdale. And I said, that's a great example of a very scalable business. You don't even need a shovel, but not every business is that, right? And sometimes you get started thinking you're going to be able to rapidly scale. Then you get out there and realize, boy, there's more heavy lifting here. We're not going to scale the way we thought we would. So what does that mean for my business? It doesn't mean it's a bad business. And you don't want your investors in that case to feel like they're completely out of, they've lost everything. They're still, with a convertible note, involved on some level, and then they can get out over time.
Yeah, it's funny you brought something up indirectly about investor communication, because I deal with it on an ongoing basis, actually. And it's funny. I mean, some guys, you just don't want to stir a pot, just let them forget about you. And other ones just want to be updated all the time. So it's really an art. I mean, I think some people just, at the end of the day, though, they all want return on their investment. So I think communication is key. But I think it's got to be customized sometimes for the person. Because some people just want to make sure, hey, you didn't just take my money and run away. But at the same time, at the end of the day, you're all on the same side of the table. I mean, the more you can facilitate that feeling, I think you get the better outcomes.
Well, and you don't want that to be antagonistic. You always want that relationship where, one, they feel you're transparent. Two, you feel they're transparent. And the reason why is you never know. You might be in a relationship with an investor, and that company ends, but they still really like you. And the next time you go out to start a company, they want to come back as an investor. And so I've had investors that have come back to the table a couple of times and been involved with me. And that's, if you don't have that as an entrepreneur, if the guys that invested the first time don't want to talk to you, other investors might say, well, why don't those guys want to talk to you? And if the answer is, well, you were a poor communicator or you were antagonistic to them, it's going to come out at some point in time. And you don't want that. The other thing I would say is that developing consistency in that reporting, especially at the early stages of a company, are so key, because when you cross the chasm and you do scale up, those are the things that can slip through the cracks. But if you're doing it from day one and it's a practice and you have a regular, at this point in time, every month we send out this report, here's what it looks like, and we know when to prepare it, you don't have that issue of when you cross the chasm, letting that slip through the cracks. And I think that's something that's really big is, the more you're communicating and the more information you're putting out in front of people, doesn't mean you have to tell them everything, but the more they feel involved, the more they can help you too. And that's something. I was just on this stage in Traverse City, and I mentioned a point, I think I mentioned it maybe on our last stream, but where an investor said, there are times when I can't help the company. But just because he can't help doesn't mean somebody in his network can't help. And if he has the information and is aware of that and says, boy, I can't help, but I know this guy over here that can help, he can have that conversation and bring that person in. and do something for you, even though they might not be the individual helping you. So sometimes as an entrepreneur, it's not just the investor, but their network and what they can bring to the table. That's actually more important than even the cash they're bringing. And that gets lost. If you're communicating, it's not lost. They're going to want to help you. And to your point, you're on the same side of the table at that point in time. You're on the same team. There is no us versus them. And I've seen a lot of situations where entrepreneurs feel very us versus them. And some of that is because when you're raising funds, it can be adversarial. You feel like you're, sparring with somebody until they say yes. And then after that sparring is done, now you have to go back to being friends. And I think I love sports analogies. That's one of the reasons why I love being an athlete, especially a rugby player. You go beat the crap out of each other, you make each other bleed. Then after the game, you sit down and have a beer with that same guy. And no matter what happened during the game, you're friends. And I think raising funds can be like a rugby scrum. It hurts. And there are times when it's not fun and somebody gets a bloody nose, but at the end of it, move on to the beers after the game.
Like Thunderdome, 2 men enter, 1 man leave, right? Or something like that.
Yeah.
So let's talk about like those success now. We talked about like the bad stuff and the dicey stuff. Let's talk about the fun stuff. So let's say someone invests like $25,000 into a startup. They have a convertible note, and things are just going gangbusters. So logistically, how does that work now? So I'm one of your first supporters. It's converted. It's like you guys are just killing it. So you just like everything's on trajectory up. So what happens to my 25,000?
So basically, you would get equity in line with that 25,000, but also at a discount, right? So you'd actually wind up having more equity. And the goal there is, the other thing about a convertible note is you're not necessarily setting a hard valuation. You do have a valuation cap, right? But at that point, the valuation of your company hopefully is going up. So now you've bought equity into a company where the valuation is going up, and your equity is going to continue to increase in value every time that happens. And that's really the exciting part, is getting, it's like having a private share of a company, and every time that something good happens, that goes up. And that can lead to a couple different scenarios. Sometimes an investor down the line will buy out all the previous investors. That's relatively rare. Maybe the company goes to an IPO, and now you've basically got stock in an IPO that's of pretty good value, or the underwriter buys you out at that point in time. So the thing is, your $25,000 investment winds up actually being worth a lot more than $25,000 in the case of a success. And that can go up exponentially. Honestly, it can. And that's, I think a lot of investors get in, they set a goal of 3x or 7x or 10x, and that does happen. It's not common that you're going to get a 10x, of course, but you can. And if you're an early stage investor, you just need a few of those to pay for all your losses and make you feel a lot better about what you're doing. And we take a time like now when the stock market's kind of iffy. It's had some, certainly some downs and other things. It can be something where the value of the company continues to go up even during lean times. You're not beholden to the stock market with that investment. You're not investing into crypto, which is very, hectic and all over the place. It's something that you can actually feel good about. And the other thing about it, depending on the company, especially if it's something like this where we're relatively consumer focused, is you can be a customer of that company and actually drive people to that company and have a stake in that company's value going up. And it's one of the rare times when you can do that and actually say, like, you can love Pizza Hut all you want, and you can buy all the Pizza Hut pizza you want. Even if you're a shareholder of pizza, it probably doesn't move the needle that much. But if somebody, invests in us, and all of a sudden they have a bunch of NFTs, they can go tell all their buddies, hey, go see if your school has any athletes on there with NFTs, and their buddies can buy it, and the value goes up because it made the business run a little bit more. And that's the great thing, is at this early stage, you're participating in a company. You're not just there as somebody writing a check. You actually have a chance to feel like you're part of not necessarily the team, but you're on the, you're in the luxury suites right behind the team at the football stadium, so to speak.
Yeah, I think a lot of people forget like the prestige of owning a startup too, because especially if you're doing well, that's a pretty cool thing to go say, I own a piece of that. And I just love that, like bringing some from
your good angel funds and venture groups have that like logo, pattern in the bottom where it shows all the companies, and they put the little star next to the one that's exited, or, this one went to IPO or whatever. And it's funny because when you've been in this space long enough, that all those funds have invested in a ton of failures, and they don't necessarily tout the failures, but it's cool to tout the successes, and it's cool to have that positive thing. And the other thing is, what we've been, there's another project I'm working on that I don't really want to talk about, but one of the things they say is, if you're an investor looking at startup companies and a guy has some some successes in his background, and you can go to other investors and say, hey, he was part of this. Was he really part of it? And they can say, yeah, that guy's there. He's legit. Now you've got some things that actually, some banners that you can wear into battle as you're starting new companies. And what you'll find with entrepreneurs is oftentimes it takes until their third company to be successful, and even their fourth or fifth till they really hit that home run, because they're still learning the practice of being an entrepreneur. Some go out and strike on the first one, great for them. But if you've got that track record of being part of teams that have built something, or that, it helps you in the future. And also you're a better mentor and potentially an investor yourself down the road. And I think now what we're seeing in this ecosystem is that coalesce more, where founders, we have Michigan Founders Fund and some of those types of things getting started, where people are saying, I want to support other founders at the point where I was 6 months ago or 18 months ago or 2 years ago, and get them through those gaps. And that's what's really cool. And for investors, for them to be able to see that and say, I feel a little bit better, because the other side of this is startup investing is not that old of a practice the way we do it now. It's been around forever, but the way we do it now, where it's almost a competitive sport, is relatively new. And those guys want something to be able to look at. And there really aren't a lot of great metrics sometimes. And, you're a CPA, so the numbers. It's great to run numbers, but pro forma numbers are only as good as the guy that put them together, right? And are they believable? Now, are there other intangible metrics I can look at? And success.
Gotcha. Okay, so I think your audio went out. Is your audio back on? Okay. So I don't know what happened, but all of a sudden the audio went out, but that's okay. We did cover a lot today, so we'll just cut it there, and I'm sure we'll do it again, Thomas. But thank you. I think it was really insightful and really enjoyed discussing with that. And then we'll